There's nothing like what we've built yet. There is going to be some sort of NFT-Fi summer. We don't want to just not do it because we're scared. We have to innovate. We have to figure out ways to compete. So the financialization of NFTs has yet to happen. Realizing that NFTs had a lot more usability and utility than fungible tokens did. The art aspect introduced an audience not familiar with a lot of the precursors to NFTs like DeFi, blockchain infrastructure, blockchain in general.
What's up, everyone? Welcome back to the Next Billion podcast, where we're talking to the builders, the entrepreneurs, the people building awesome stuff. And I'm joined today by one of my friends from back in the day in, I guess, DeFi summer, Tytan from NFT-Finance, as well as other things like Social Pass. But look, Ty, it's great having you on the podcast today.
Thanks, George. I appreciate it. It's always a pleasure to chat with you. And yeah, I mean, I think we go way back to DeFi summer. Those are the good days. Hopefully we can bring those back soon.
Well, I'm hoping as well. You know, it was pretty cool to be going through the same experience with everyone at the same time. Like, we can talk about this as well, like in the NFT world. But I guess, you know, a couple of years ago when DeFi was really taking off, we were all sort of in the same boat, right? We're like, what's a yield farm? Oh, wow, it's this crazy concept. What's an AMM? Oh, wow, it's this crazy concept. I'm hoping those days return of awe and that sort of thing. But I don't know. Are we past it? Are they coming back?
You know, the funny joke actually in a group with a lot of NFT-Fi people is that NFT-Fi summer is coming. Now, I don't know if it's going to be summer, maybe it's fall, winter. We don't really know. But we're all hoping that, you know, at some point there's a huge, you know, flow of money and energy into like NFT financialization. I think it's like coming. So we might have some days like that, but it might look a little different.
That's it. I think it will look different. And that's actually the cool thing. We don't know what it'll look like really. But yeah, let's get into it. I usually start with what's the crypto journey been like for you thus far? And I guess a lot of candidates, you know, they come on the podcast, they're saying, oh, they started fairly recently, or they've been in it for years, or, you know, what's your story like? What's the Tytan story been so far in this crazy crypto land?
Yeah, thank you, George. It's been a journey for sure. I started out in 2017 at the Pico top, and my first investment was like Litecoin, and I think it was like around like maybe 250, 300. So got in right, at the top. And I think that was actually pretty good for me to be able to just kind of like double down on like learning exactly what my investment was and what it could translate to in the future. So, held on to a lot of bags and, try to funnel a lot of money into, crypto from my day job and just tried to learn as much as possible on the way.
And what were you doing? Like, what was your day job at the time?
Bro, I was a manager of a T-Mobile store.
Let's go.
So, yeah, man. So I was managed at T-Mobile. Before that, I had actually, tried my foot in, building businesses before. I had like an IT company when I was like 19, 20 years old. So, I was doing a lot of things, pretty young. And I always knew that I wanted to do, some sort of entrepreneurship. And I had a feeling
from the start.
Yeah, of course. It's even like as a young kid, like being like 13 years old, I was like modding Xbox controllers, trying to like sell them to people at school, So, I always wanted to do it. I knew I did. And there was nothing that was going to stop me from, trying to figure out like where would I fit in. And then I saw like the opportunity with crypto and started just diving in. And the big thing for me was that the tech and the financialization, it was multiple different things coming together. And I was like, I don't understand any of this. I don't even understand the financial aspects, let alone the technical side. And I really wanted to understand it. So I took that as a challenge on myself. And I started to actually make some content around like 2018, 2019 on YouTube, because that was kind of like my background before getting into crypto and stuff like that. When I was in high school, I was making Minecraft videos, making like $4,000 a month on YouTube.
Oh, that's awesome. Was that before YouTube was, their monetization thing or whatever? That's awesome, man. Jeez.
Yeah, that was when, the cost per clicks were much higher and you could actually make money on advertisements. And so that was definitely a fun time for me. And, I just had the background of doing that. So I felt like I could apply that. And then, 2018, 2019, making some content. But then, late 2018, I got the opportunity to travel to Asia, because my brother actually lived out there and still does. He lives in the Philippines and has a house in Thailand and stuff like that. So I ended up in March 2019, flying from Atlanta, Georgia, all the way to the Philippines. And then funny enough, my flight from LA to the Philippines was canceled or delayed. And so I had to stay a night in Hollywood, first time in California. And I met my current business partner actually today, Digital Lawrence, in California at that time. And so that was really cool. We got a chance to meet him. It was literally only one night, but we got a chance to meet each other, and then actually, like, you know, has translated to all the stuff we built together. But then I ended up going to Asia, spent 9 months out there, went to a lot of the conferences, you know, like was it like Consensus, like Singapore. I mean,
Oh, you went to that one?
Yeah, 2019, Consensus Singapore.
I was speaking there, man. I was on a panel with Do Kwon.
I think I remember that actually. And then Korea Blockchain Week, I was out there too. We did some stuff in Bali, DEF CON Osaka. I was there as well.
That one. I remember people were posting about that. I remember when that went down before COVID, people were saying it was awesome.
I think the reason was because Uniswap had like unveiled, some early updates for V2. And I think that was why people were kind of like, you know, hey, this is like pretty big. But, you know, in general, did all that kind of stuff. And then really like, you know, past COVID, started building some NFT technology with my business partner, Digital Lawrence, and our additional 2 team members, Olivia, our creative designer, and then our CTO, Kevin, and came up with Social Pass, one of our first products. And that product has done really well. We partnered with Pudgy Penguins on that one. Got some cool stuff coming up on that front. And then more recently, of course, we started the development of NFTY.Finance about a year ago, or a little bit more than a year ago. And we're going to be on mainnet, let's say T-minus 30 days or so.
That was my first question when I was checking out NFTY.Finance, was when mainnet. So awesome. Coming soon.
Coming soon. We have definitely spent a lot of time just like kind of refining some of the contracts. You know, there's always gas optimization, stuff like that. But most importantly, you want to like compete day one when your contracts are out there, because obviously once they're out there, like, you know, you can't just be like, oh, we'll just change the code a little bit. You got to redeploy. So.
Well, amazing. Well, look, I think that's a really solid base. I want to dive into some of these things like the events, the NFT side of things, but maybe just on the event side with Social Pass. So that was your first product, right? And what was the need? Like, you went to all of these events, right? And I remember back then, a lot of these crypto events, it's like, hey, we're a crypto event. We're going to tell you about the future of finance. By the way, you should pay with your credit card or something like that. I'm like, man, why? Like, can't we just pay with crypto to these things? I mean, was that one of the realizations, or was it about what else more you can do? Like, I know people, you know, the POAPs and other kind of stuff that people go crazy about, and NFTs for like proof of attendance. I don't know, like what was the initial vision, I guess, there of making sort of events better?
Yeah, I think, you know, realizing that NFTs had a lot more usability and utility than, you know, fungible tokens did, at least at that time. Like early 2020, late 2020 even, there was a lot of talk about, you know, NFTs and the possibilities, but we hadn't seen really anyone necessarily innovating, you know, using those NFTs for access-based systems. And so we initially set out with our first company, our parent company now, Nifty Labs, to build technology for access-oriented systems. So, you know, can you use an NFT to get into an event? Yes, we proved it. We did a demonstration, or just a display. It was like 2021 in Miami. It was one of the conferences. Justin Wu, I think, was one of the organizers. Can't remember the name, but that was fun. We got to distribute, or just kind of demonstrate to a lot of people, like, hey, we could actually use NFTs to, you know, give you tickets, which was really cool. And then, you know, the reason that we wanted to do that was because we really felt like NFTs could allow people without bank accounts and without being in sort of like these, you know, these financial inclusive or exclusive systems, that you could use an NFT to get into an event, for example. Or you, like you said, you could use crypto payments to be able to pay for your ticket. But the thing about crypto payments with ticketing is that a lot of the payments providers, the on-ramps, off-ramps, they don't particularly like the ability to be able to pay directly for a ticket with crypto. So instead of that, at least for now, I mean, maybe they'll change that in the future, but instead of that, what we have instead is using NFTs, which are these, you know, a lot of times they're people's brands, they're PFPs, obviously. You could make NFTs just tickets on their own, but there was a lot of opportunities just in that alone that we could kind of experiment with. And then we found that with a lot of these like PFP collections, like Pudgy Penguins, for example, they had a very unique use case and need for being able to use NFTs as tickets to these events, because, you know, the PFP is your representation of your involvement in the community. All these community members want to be able to...
I am my Pudgy and my Pudgy is me, right?
Yeah, exactly. You know, they want to be able to go to the event and say, hey, like, I actually, you know, I am a approved member of the Pudgy Penguin community, and I can prove it because I'm here at this event, and so are you. So now we're both pudgy penguins. We get to meet each other and know that, like, you know, it was not somebody just randomly off the street who paid a, you know, $100, $200 ticket fee. So that's one of the reasons. There's a lot of other reasons, obviously, that we kind of went down that route. But one of the things we wanted to make sure of was that we made the UI UX of the platform very easy to use. You know, we are using NFTs as technology, and it does obviously add a complexity factor, you know, for the usability of the platform. But we still made it a way that, yeah, as long as you understand like MetaMask at a baseline, then you can still use this platform and use your NFT as a ticket. So
that's a really good comment about pudgies meeting pudgies, right? And is this actually the use case for NFTs? Is communities, right? People use the word community a lot, right? And often we're talking about online communities where we're all in there in Discord talking about whatever community you care about. But I guess when it comes to conferences, now that I think about it, if I go to a conference and I see a whole bunch of other people that have got a conference ticket, I don't quite know if they align with my values and all these other things. They just happen to be people that paid for a ticket, right? But if I go to a pudgy event and I see all the other pudgy holders, I know that we're at least aligned on a lot of different things, and people love being part of a community like that. And it's kind of like that sort of community gating. Is that one of the use cases for NFTs?
Absolutely. And I don't think people give that enough credit. I know we kind of talk about the speculative side of NFTs and, you know, the art and all of that. But really what it's doing is, I mean, you obviously, as a owner of these NFTs, you align with the art, right? And the uniqueness of that art, just like you would a collectible, right? I own this, and, you know, it gives me certain privileges. But beyond that, like, it's only a very, you know, selective amount of people that are in that unique club, that community. And right now it costs, you know, for pudgy penguins, it costs around 4+ ETH to join that community, which is a hefty, you know, price to pay if you want to join that, you know, sort of, you know, selective elite community. And then you can also know that the people in that community have similar interests. We like penguins, we like NFTs, we like assets that go up in price. And so, you know, you can kind of like at least bond around those qualities, and then know that like everybody in there knows something about the pudgy penguin lore, for example, and you can relate to them very easily. Whereas, like, you know, you go to a just general meetup at a side event for a conference, you know, anyone could be there. I mean, you could be from DeFi, you could be from blockchain infrastructure, you could be from NFTs, and so you don't necessarily all share the same sort of, you know, relatable topics or subjects. So I think the main use case for PFP is definitely like community, and it's under leveraged, if you will.
That's a good point. So does that limit the market size if you're trying to focus on, say, NFT events or something like that, where it might only be focused on an exclusive community, which might be thousands of dollars to gain access? Not every guy on the street can walk in and attend. Is that a feature or a bug, or I don't know? What's your take on that?
Well, in the specific case of pudgy penguins, what they've started to do is make it so that their other, you know, sort of secondary and tertiary collections like Lil Pudgies and Pudgy Rods are also usable to gain as tickets for their entry. So they're finding ways to sort of dilute the collection, or rather not even dilute, but just offer multiple collections within the series to be able to, you know, join the event. Now, additionally, if they really want to be able to like serve emerging markets and just different regions around the world that either A, don't have access to, you know, bank infrastructure, or, you know, just don't want to, they could still do, you know, NFTs as tickets easily, and then just say, hey, we're going to distribute either, you know, by, you know, just paying through ETH or airdrop, one of those two options, right? So there's still the ability to make sure that like people aren't excluded just because of the financial ecosystems around them, but rather just like, hey, like you can either, you know, buy this asset or not, or buy this ticket or not through NFTs, and then just use that through the platform. So it just makes it so that you don't have to have a bank account, you know, to be able to go to an event.
Which I personally love. And I think most people going to crypto events should kind of have that mentality. I mean, that's kind of why we go to these crypto events, right? Is to talk about this kind of stuff. But so NFTs, maybe taking a step back, really became a thing probably, 2020, 2021 really took off. Before that, it existed, but it wasn't such a huge phenomena. Then it became massive. We had mainstream news from everywhere talking about it. We had millions of people being onboarded. We had these marketplaces, which were OpenSea at over $1 billion valuation. I think Magic Eden did as well, and some other people. Like, why was that? Clearly something resonated, and we all thought that people would come in the next wave for the coins or the yield farms or the complex financial things. But actually they came for really awesome, like cool art of penguins. Like, what do you think was behind that?
I think the art aspect definitely introduced an audience not familiar with a lot of the like sort of precursors to NFTs, like DeFi, blockchain infrastructure, blockchain in general. I mean, those are really cool topics, and I think you and I could, talk about those all day long. But for a lot of the audience that came in on 2020, 2021, they were more sort of creatives, sort of in the entertainment or pop culture side of the demographic. So that introduced a very different segment of customers or users or holders, whatever, than what we'd had in the past. I mean, a lot of the Twitter timeline pre-2020 was like, hey, Bitcoin is, financial security, or hey, DeFi is going to change the world with yields, on chain and all this kind of stuff, right? And that's cool, but it doesn't really cater to the current NFT audience. And that's why I think a lot of, influencer accounts and, different people who operated from like 2017, 2020 never really adopted a lot of those NFT audiences, because they're entirely different. And they're really just based off of like culture, pop culture, entertainment, art, creative sort of segments of audiences. And I think what happened is, the first sort of big instance for NFTs was Axie Infinity with the gaming, right? And that kind of brought people in. And then you had Bored Apes, right? Where you have this art, this just like monkey art that somehow, goes from zero to, hundreds of thousands of dollars, even millions in some cases. And that really just opened people's eyes to the idea that, hey, maybe content, maybe art could be worth something on chain, and I should really look into this, because I am a creative and I am like sort of in that pop culture sort of segment. So I think that's probably what it did it. Obviously, like there's certain NFTs that might have got some help on their prices and stuff like that, but it all definitely helped interest people in the industry itself. And then obviously from there they can sort of branch off. They could go more to DeFi if they want. They can go blockchain, however they want to separate from there.
And do you think those two segments are ever going to come together, or is there much sort of people that are able to cross the divide? Because I remember a while back, what was that Twitter thing that people were doing, and it showed like the graphical representation of circles of people that you follow, and then pretty much it was all across crypto Twitter. There was like DeFi people have their own circle over here,
yep,
and it's very distinctly different to NFT people that have their circles over here. So literally, like they often don't even know that each other exist. Even though, like, why are people using, say, MetaMask or Phantom or any of these other wallets? Like, often people are using them for entirely different purposes, and they have no idea about these other worlds that exist out there. Are they ever going to cross? What do you think? Like, I don't know.
That's where we can get into, especially like DeFi and NFTs, we can get into NFT-Fi, which is sort of a newer phenomenon, newer like keyword. And I'm trying to do my best to educate a lot of like both the DeFi and NFT people and bring them together under this new umbrella, because it's very interesting, and it actually has a lot of reasons why people would want to get interested in it. And
I just want to get like why do you say that? Like, why would they cross?
Financial reasons, really. I mean, essentially,
number go up.
Yeah, number go up. Yeah, I mean that's the baseline. So with NFTs currently, and I just actually replied to Jonah, a popular Web3 gamer Twitter account. He actually put out a tweet that said something to the effect of, is NFT-Fi really needed? Do we need to trade NFTs or financialize NFTs just like we have for tokens? Like, can we just like keep them separate? And my answer was, yes, we do need these things, and the reason is because with NFTs currently, they're illiquid by nature, right? They have that functionality. It's built into them. They're supposed to be unique, unless you have 1155s, of course, ERC 1155s, which are obviously semi-fungible. But with the ERC 721s, which is most PFP collections, they are illiquid. And the problem with that is, a lot of people who would like to be able to participate in the market, they cannot, because they have to own a full asset to join the market, right? Or to participate. But with NFT-Finance, essentially what it does is it allows for deeper liquidity, because you can, own a part of it, for example, by just maybe doing a call option on Wasabi, Or you can go to dive.xyz and do, longing, shorting, whatever you want to do. Or you could borrow against, existing assets or lend against them. And so it just creates deeper liquidity and more options to be able to participate in the NFT industry specifically through DeFi mechanics. And obviously the number one reason why anybody would want to participate is because of incentives, financial incentives. If you can be able to make a call option on a Pudgy Penguin, for example, and you don't have enough money to be able to purchase an entire Pudgy Penguin, well, that might just make you a couple $100 to $1,000 depending on how much you're putting in for that option. And then on the other side, the deeper liquidity will just make the experience much more seamless for existing NFT holders because they won't be dumping into these huge spreads on the markets currently because there's not enough liquidity to support those collections and the floor prices. So a lot of different reasons, but mostly financial incentives. Once the NFT people figure out that you can actually earn yield on the NFTs themselves through DeFi, and once the DeFi people, of course, figure out the same thing, then everybody's going to come together under the same umbrella, and they're not going to be sort of like, oh, well, NFTs are pop culture, and DeFi people won't be like, it's math science, we can't possibly come together. So.
But does this remove the fun from it? If we're all talking about charts and financializing things, part of the magic of NFTs was everyone's just super happy to talk about their pudgies and to respond to people on Twitter with their pudgy and stuff like that, right? Like, does this remove some of the magic of that?
That's a great question. I think what's fun is making money personally. but I do understand.
Fair point.
Yeah. I understand there's going to be a lot of NFT people out there that are going to go, hey, this doesn't really concern me. I'm going to stay in my own lane and do my own thing with my pudgy. And that's cool. And, if there becomes a time where maybe in the future they need to liquidate the asset or any of their assets in their portfolio, they're going to definitely hope that there's enough liquidity for them to do so. Right. And right now, even before like SudoSwap in 2022, liquidating your NFTs was very difficult. Obviously, you had to sell into existing bids if there were any. And so that's not very fun, right? Especially when you need to be able to get liquidity out of your asset and you can't. And so I think what's fun is being able to know that your NFT, your asset, which it is an asset, I mean, at the end of the day, you can actually get some liquidity out of that asset if you need to, but without having that ability, that removes a use case, really. I mean, that's a utility, being able to get money out of your asset. So I think, what's fun is being able to still play around with your asset, your NFT, use it for all the utilities like, social pass, like, for ticketing and things like that. But then also at the end of the day, if you really need to get liquidity out of that asset, you can. And that's where, NFT-Fi would introduce that or introduce more liquidity than current.
Well, let's talk about that. What you've got going on with NFT-Fi. So a lender, right? But how is this different to what else is out there? Or I guess, why should people, consider you guys as the other options that are also out there? I don't, like Aave certainly proved that you could create a DeFi lender and grow a massive TVL and do really good for like many years, right? And I think they've all proven to the market and they're going to be around for a while, which is great. But tell us about, NFT-Fi and what you guys got going on there.
Yeah. So, as I was kind of talking about, a little earlier, with NFT-Fi as a new sort of sub-niche of NFTs and DeFi, right? It bridges the worlds together. And so what we've actually done now with our company, NFTY.Finance, is we have made a sort of permissionless infrastructure for borrowing and lending. And I'm going to try to do this in a way that is very easy to explain for all audiences. But essentially what exists right now is a lot of different peer-to protocol or peer-to-pool platforms that essentially is just like, you can interact with other peers, for example, for borrowing and lending. So, somebody could give me a loan directly, or I can interact with a pool to be able to get liquidity against my asset, right? And of course, my NFT would stay in an escrow vault where that will stay until I pay off the loan, for example. And those are really the two existing sort of models for, protocols currently. Now, what we're doing is we're taking a spin on both of those, and we're introducing, we don't even really know what to necessarily call like the mechanic type, but basically the way it works is...
A crypto people got to make up a name for everything, man. You got to call it like Cloud Moon something, whatever.
Exactly. Cloud Moon, Big Cloud, 49,
Yeah.
you know, whatever.
Yeah.
So throw some new terminology in there. But essentially the way it works is a lender can own their own pool that can then make loans against NFTs. And so it's very much so like peer-to-pool, but also it's every single loan is executed as a peer-to-peer basis. And it's all automated. So let's just say, for example, you know, a lender wants to come in and they want to loan against some collections. The really novel thing that we do is we actually allow anyone to use any ERC20 token as their lending currency, and they can lend against any NFT. So it's ERC 721 and ERC 1155. So it's really like the bare bones infrastructure of the way it should be in the industry currently, where you can use any token, kind of like, you know, Uniswap, right? And you can lend that against any NFT, very similar to like SudoSwap. So we're taking two different inspirations from, you know, two very popular protocols that created what we have today, you know, in DeFi and NFTs. And so, you know, as a lender, you create your own lending desk is what we call it. You can use any ERC20 token. Let's just say you've got a Pepe, you know, lending currency as your token. You know, why not? And you want to lend against, let's just say, Pudgy Penguins, Bored Apes, and Sappy Seals. And essentially the way that would work is you could actually adjust the parameters for all three of those collections to support, and you can do it in an infinite number of collections, by the way. And then essentially for your parameters, you say, hey, it's my minimum maximum offer ranges, minimum maximum durations, and the minimum maximum interest rates. And then from there, the borrower obviously can choose to borrow from your lending desk specifically. They have the term ranges that you've already set on those parameters. And as long as, you know, one of those collections is, you know, requested, you know, for a loan against, you know, Pudgy Penguins, Bored Apes, or Sappy Seals, you can get a loan. Now, obviously, when you run out of liquidity, you got to refill it and stuff, but that's, you know, it's the same with a pool. And so that's basically how NFTY.Finance works. So it's very permissionless. We don't actually control any of the owned liquidity. It's all owned by the lenders. So, you know, we don't have any say in like what people do with their funds. We have no say of what happens after the loans default, for example. If the loans do default from the borrower, the NFT is actually just sent to the lender, and they can just liquidate that asset, of course. So it's all very permissionless. We're just facilitating the interactions that people will have, you know, between borrowers and lenders. So,
and I guess a couple of the benefits. I mean, currently you take sort of if there's a pool concept like Aave, right? If we're all interacting with the same pool, we all take risk in that pool. And if something blows up tomorrow, like a curve pool or something like that, which is one asset in the pool, let's say, everyone in the pool gets wrecked. Whereas you're saying with this model, everyone has their individual deals with everyone else. So it's like one thing blowing up or someone defaulting on a loan somewhere, it's not going to blow up everyone else. Is that right?
That's correct. I mean, essentially, our thesis is that there are a lot of lenders that want to be able to take all the risk themselves, because then that also gives them all the reward themselves. And the current issue, at least now with peer-to-peer lending, and by the way, let me just preface, the current peer-to-peer protocols that are just top-notch are RK.XYZ and NFT-Fi.com. And I'm a big fan of both of those guys. I really am. I love those guys, the teams, the products. They're very sleek. I would highly recommend them. But with that being said, there are no automated peer-to-peer solutions, right? And the reason that is because there's nothing like what we've built yet, with being able to use a pool to be able to distribute your liquidity and just have that done automated, right? And so our thesis is that there's a lot of lenders and they want to be able to take on the risk of lending against an asset like an NFT. You know, in PFPs right now is the current scenario, but in the future, we believe it'll be, you know, RWA's real world assets. And so they want to be able to distribute, you know, liquidity across these NFTs. And they might even want to do that for, you know, extended periods of time. They might want to do it for, you know, 120 days, 365 days in some cases. We don't really know. But we do know that if we provide the infrastructure and the ability to do so, people will experiment. You know, they might experiment with ApeCoin loans, for example, you know, for 24 hours or maybe 90 days. Who knows? But we do have a thesis that there are a lot of lenders that want to get indirect exposure to NFTs through these borrowing and lending protocols, but there's nothing automated and there's nothing that fits maybe their needs in terms of durations and in terms of, you know, sort of options, you know, with being able to lend against any NFT and use any currency for that purpose.
So what kind of parameters can I adjust when I'm making a loan? Like what comes to mind is, say, LTVs. Like, can I just set an insane LTV and borrow that, you know, use that as, and maybe like, I don't know, if the parameters look really risky for me, as a lender, like, maybe I want to adjust that, or how does that work? Like, do I just have freedom to set whatever I want?
It's very similar to like Uniswap v3. We call it, it's just a sort of like active liquidity management, but for lending. Because, if you don't adjust your ranges every now and then, and the floor price drops, then you're going to be, executing loans that are maybe a little higher than floor price, or at least a little higher than the range that you'd like. So anytime if you want to modify your settings on the lending desks, you can actually do that. No problem. You can go, hey, I want to adjust the ranges for pudgy penguins because I have a feeling they're going to go up in price or down in price, whatever.
Wait, I can do that for active loans or only new ones?
You can do that for new ones, essentially. So you're adjusting the parameters on the lending desk that borrowers would then, of course, borrow against. So, if you've got, let's just say, a offer range from like 5,000 to 8,000, which I think is a little bit under floor price currently at the top, then your loans would always be a little bit less than the max floor price or the base floor price. And then that way you always know, hey, look, at minimum, I'm going to be able to get this NFT at a discount if it does default, right? And so that's the way you can easily adjust your parameters. You can modify at any time. You can't modify existing loans, but what's really cool is we have these things called nifty notes, where essentially they represent your borrow and lend side of a loan position. And the borrower can sell their position if they wanted to someone else, meaning they'd have to pay back the loan. And if they do, they get to keep the NFT. And the lender can, of course, do that with their own NFT as well, or their promissory note, which is their lender side of the loan. And they could, sell the future yield to that position. Basically, they could even borrow against those positions as well, which is super degenerate, but yeah. You can do whatever you want. It's permissionless,
I like that. You know what it reminds me? It reminds me of the original Bitfinex order book. Like, that was really the first lending order book that has been around since forever. Actually, by the way, for those who don't know the history, Bitfinex was started from leaked code of, some other project, a guy called Zhao Tong. People can look it up. But they created this sort of idea where you can set durations for your loans. And in this case, it was leverage on Bitcoin. But ultimately, it's a similar kind of thing. Like, do I want to lend for 2 days or 30 days or 60 days? And I want to set the interest rate for that. And then, I, as someone there who maybe has some assets that I want to lend, I can then actually just go and choose what I think is the appropriate loan that I want. So I guess at the end of the day, you end up with just a whole bunch of people with a whole bunch of different rates. I guess displaying a lot of that information on a UI is quite difficult, right? Because you have a lot of different things going on. I mean, is there any thought there on UX, on how that can actually make sense to peeps when there's like a million different parameters at play?
Yes, and you have great questions, by the way, top notch.
So degen questions to degen to degen,
Of course. Only degens know. So yes, we do. We have a quick loan aggregator. So the way it works is you would essentially just come into the platform. And by the way, all of the options are on your left-hand side. So we've just kind of put everything there to make it easy to find everything. But essentially, you'll have your quick loan aggregator as a borrower, and you can go and say, "Hey, I have a pudgy penguin, for example, and I want to just be presented with all the currency options first that are available for my pudgy penguin to be able to borrow against." And so you select your pudgy penguin. Then the next step, you've got all the currency options. So it could be USDT, USDC, Pepe, ApeCoin, whatever you're interested in, right? Whatever you want to be able to get liquidity in. And then from there, of course, once you selected your currency, you'll be presented with all the options that are available for that particular currency on that particular, NFT collection. And, some of those rates could be crazy durations in terms of the max ranges. Some of them could be very short ranges for duration. Some of them could be high interest rates. And so you don't really know. I mean, it just depends on like what lenders are willing to provide in liquidity. And if the lenders find out like, hey, I can be more competitive by, maybe offering a loan in USDC at a lower interest rate, or, offering Pepe at a higher interest rate, lower interest, just whatever they want to do, whatever competitive ways they want to compete with other lending desks, they'll be able to sort of try that out. And so instead of us just aggregating all of the lenders in one pool and then just auto sourcing those deals, we're really letting the market determine what is the value of maybe the loans for these NFTs, and then also like what's the sort of I guess discount if you're using like a Pepe or a Shiba Inu, right? Does it have enough liquidity to support sells in some of these tokens? Because you'll be able to use anything. And then another thing I wanted to note is that there's no oracles.
If people use like a random NFT, or say they're borrowing against some sort of random ERC20 token or whatever it is, might not have that much liquidity. You know, if you need to dump a lot of that and you're borrowing against your Bored Ape and you need to liquidate a 100K loan or whatever it is, some big number, and then the slippage on selling this random thing that you've borrowed against is really high, well, you could get wrecked there. So I guess, you know, hey, you should take that into consideration as, you know, when you're looking at these deals.
Right. And there could be some, you know, in some cases, people might want more ApeCoin that they can just stake. So then maybe they'll take a loan on an ApeCoin that they can just immediately stake to the pool. So we don't really know how people are going to use it. But like I mentioned, there's no oracles. So there's no need to sort of automatically evaluate, you know, new NFT collections in the market. It's not going to be done anyways because there's no oracle that support that. And then on the other side with like tokens, a lot of times they don't get oracle support either. Like for example, Chainlink only really supports your price in their oracle at a certain volume or a certain market cap for your tokens. So, you know, a lot of times you're not even going to be able to get support anyways. So just throw it out the window. No need. Let the lenders and borrowers figure out what the market is.
So how does liquidation work if there's no oracle? Is it just that if I default on payments, then that's a liquidation event?
Yeah, so essentially, if you're the borrower and you default on payments, essentially the NFT is given to the lender as a liquidation. However, there is a grace period, and there's some math behind the grace period, but essentially it's 12 hours plus percentage of time times like duration. So if you have like a 30-day loan, you've got 12 hours plus you know, the duration times percentage. So we do give a grace period to make sure that like if there's some crazy scenario that happens, you forget to pay your loan off or whatever, you will still be able to, you know, pay off that loan with additional interest, by the way, that is of course paid to the lender for having to wait an additional 5 days or however many days, right? And so that's something that we added. We wanted to make sure that borrower protections were really in place, just because, you know, in the case that you do default on your NFT, it might not be your fault. You know, maybe there's certain circumstances, scenarios that come up.
You're in a boating accident and you lost your ledger, and
who knows? Who knows? And so one thing I haven't talked about yet is actually how the Nifty token, our protocol token, integrates into the protocol. If you want me to, I can kind of expand on that.
Absolutely. Let's get into it. Yeah.
So one of the things that we know is very important for protocol participation is the ability to have some sort of incentive. I mean, that's Web3 in a nutshell. You know, if there's no sort of incentive, financial incentive to be involved, or utility incentive, then most people just don't use the protocols unless they absolutely have to because other protocols don't support their needs. And so one thing that we did actually is
like customer acquisition cost as well. You know, it's a way that you bring customers in, and yeah, it costs by shelling out the token often in the past. Yeah.
Yeah, exactly. Yeah. No, you're good. That's good points. And so one thing that we actually did was, so with Nifty token, what you can do is you can stake into an insurance fund, is what we're calling it. And the way it works is you stake LP tokens. So you can do Nifty and you can zap it into, you know, like ETH Nifty, for example, or you can take ETH Nifty from the get-go and then you can contribute that to the insurance fund. And then from there, you actually receive a discounted Nifty token, just like a bonding protocol, you know, very, very simple. And then that way you can actually sort of offset maybe some of your costs on defaults from loans using the staking rewards that are coming from the Nifty LP. And the reason that the LP is so important is if obviously somebody unloads a lot of Nifty, no problem. You put in an equivalent number of LP, at least initially, you know, to be able to receive, you know, the discounted Nifty on the other side. So it should be able to sort of support a lot of price action, especially like sell pressure in a lot of cases. But that's one of the things we did. And the way that the tokens actually get into the insurance fund is the coolest part, because what we're doing is we're sharing revenue from the protocol. And I think it's about 0.25% of our total revenue that we're putting into the insurance fund. So the way that the fund is funded from profits directly from the protocol. And the way that works is we take 2% off of every single loan transaction. And so that could be in like ApeCoin, it could be Pepe, who knows? We'll just get a bunch of different tokens across the board, and then we'll have to convert those into Nifty to be sent to the insurance fund. So as long as the protocol is generating, you know, loan volume, loan transactions, theoretically, the token should perform pretty well. in terms of, sort of liquidity, right? In terms of people staking into the pool to add more liquidity. So that's an interesting aspect that we added with the protocol. And then, of course, using it as a lending currency, it's an easy one. We can do discounts on, using that as your lending currency. So discounts for the lender, discounts for the borrower, just different ways to sort of gamify. But that's the primary sort of mechanic that we have in place right now.
So the yield in the insurance pool comes from protocol revenue of the 2%, correct?
Yes, correct. Yep.
See, that's the way things should be done, right? Because you want to align incentives with the protocol. We have a similar thing at Step where basically, look, if the protocol does well, like you want holders to be able to share in that, right? And I think that's where maybe a couple of years ago in DeFi, when it first sprang into existence, it wasn't doing that. It was kind of just spitting out food coins here and there for like no purpose. But then I think after the bear market came and wrecked everything, people really sort of doubled down and focused on actual protocol revenues, an important thing. And you've got all of these different, websites that are reporting on it all over the place. But I think that's really important point, that the yield is actually real in that case, right? Because, it's real yield, it's protocol revenues. So it's not just printing coins infinitely and see you later.
Yeah, and that's what we wanted to do. We wanted to create real yield. And I think that's, like you said, that's where everybody's going. We're trying to find real yield in this form of maybe yield from collateralized treasury bonds, like with MakerDAO. What they're doing now is they're backing MakerDAO SDAI with treasury bonds, and so that's a real form of yield, at least currently, because of the current macro scenario, economic scenario. And so we're trying to think out the same thing. Like, can we add the ability to generate revenue and then source that to the insurance fund so that people can be able to participate in the growth of the protocol? Like, why not? And then also thinking through like ways to become more decentralized. So removing a lot of getting a lot of the tokens out to holders and away from us, so that we can be more compliant, especially with all the SEC precedents and regulations going on. We're trying to be a legit company, right? We know
hopefully Gary's gone soon, by the way.
Hopefully, I mean, it seems like Hester Pierce might replace, but we'll see. But in the case that he's not, like, Gary, love you, bro. We're trying to be more compliant. We're doing our best. Like, we're not trying to screw anybody over. We're trying to like just figure this stuff out, right? And think through these mechanics. And this is stuff that we're able to do, and we don't want to just not do it because we're scared. We have to innovate. We have to figure out ways to sort of compete. So
I love it. And as well, like the point about no oracles, man, that makes life so much simpler. There's been so many oracle situations that have happened with lenders, whether it's exploiting like price differentials or liquidity and that sort of thing. I know that happened with Mango. Curve had a whole situation that was going on. Like, oracles play a really important role, but if you can run a lender without oracles, that makes life so much better for you guys as well, running the protocol, as well as anyone else who wants to participate. It's just like a massive level of risk, which has now been removed because, hey, maybe the oracle of Pepe Coin is great. Maybe it's not. Maybe it comes from 3 centralized exchanges and they all shut down tomorrow or something. Like when FTX blew up, I think a lot of Oracle feeds like blew up all over the place because that's where they got the majority of their weighting for volume for certain tokens. So that's really cool. I like that part of the design. So look, we're halfway through 2023 now. I don't know how that happened. Or actually, we're more than halfway through, over 50% now, right? Month number 7. But what do we got in store for us? I always sort of say this. Predictions, what do you think's coming for 2023? Certainly, we've been talking about the collaboration of NFT/DeFi and bringing them together. Are we going to see more of that? Is it something else that we haven't even seen before? I mean, what's your take on what we got sort of happening in the next, I guess, 6 months or 6 to 12 months?
Well, the obvious thing in the room, I guess, is the Bitcoin halving. Right, that's a big event coming up, and I don't think a lot of even the NFT people realize how important that's going to be. And I think we're already seeing sort of like the initial pricing in of that halving, with a lot of the institutions starting to get involved. I mean, BlackRock, of all companies, wanting to file an ETF. That's huge. I mean, I don't really think most people understand that.
Here's a question. Do you think what's more important, the halvening or BlackRock? Because my take on the halvening is that, like, okay, let's say you look at mining revenue or how much like Bitcoin is printed from miners, and then you look at volume on the exchanges. It's like nothing. Like volume on the exchanges in the billions, and then the amount that's like issued being cut in half each day is like, okay, a couple $1,000,000, cool. Like, does it really make a difference, or is it BlackRock, Fidelity, all of these other people that are actually going to make the big difference?
I think ultimately the halvening is a good narrative, and you know the actual halvening itself, I think will be at this point in Bitcoin's journey. I don't know how much of a change it's going to be, like you mentioned, but what I do think is important is that these institutions do think that halvening is important, right?
It's the narrative that's important. Let's go.
Exactly. It's the narrative that, it's like narrativeception.
Yeah.
So I think that's probably the most important thing, is just seeing these institutions take it more seriously. And so that tells me they know something that I don't know, or maybe they know the same thing.
I'm sure we know more than the boomers. Don't worry.
I would hope so, right? So that's like the first thing. And then the second thing is I think the financialization of NFTs has really yet to happen. We have the protocol infrastructure to support it, but people just really aren't, like, their heads aren't turning yet, at least in terms of what's possible. And then we haven't even gotten into RWAs. Like, we've seen, a few times where, like, a Roofstock, for example, they did, financing of a house on chain. And that was cool. We've seen some physical collectibles get tokenized as well, watches even, and then, loans against those. But that's all early stuff. This is really all sort of like just, case studies on the possibility of, sort of financializing these NFTs and these on-chain assets. So moving forward, I think there is going to be some sort of NFT-Fi summer where NFTs do get financialized, and there's a big craze to do so. The founders will all sort of take note and go, oh, like, we were way ahead of this like 3 months ago, and now we're like in it, And so I think that's probably the two sort of biggest narratives, is like institutions getting into Bitcoin or blockchain in general, Ethereum, and then, NFTs getting financialized through these DeFi protocols, and then everybody else following suit. I mean, these trends will sort of create themselves, especially with like the financial opportunities. So in terms of price predictions, Bitcoin to 100K. I mean, 100K seems reasonable, I mean, that's in the next cycle. I'll give it like 6 months after the halvening, when things start to really get interesting.
I totally agree. I think, I think that's probably where we're heading. Well, look, thanks so much for your time today, Ty. And where should people go to find out more? I know you've got the launch of the protocol on mainnet coming up like 30 days, you said. So we're mid-August recording this. Probably by the time you see this, it's going to be pretty close. So where should people go? Twitter, blogs, websites, find out more?
Yeah, so they can go to I think it's like twitter.com/NFTY.Finance, NFT-Finance. You can find me on my personal as well, twitter.com/Tytan Inc., TYTANINC. So those are probably the two main sources. And then if you guys want to check out Social Pass as well, our other product, twitter.com/socialpass_IO. So check out those resources. We got blogs in both of those companies, so you can just find the links down there. On the sites themselves. And then if you want to follow me, I typically quote tweet everything anyways, so you'll find it. But yeah, thanks, George, for having me on. This has been an awesome podcast, and look forward to joining you again maybe in the future.
Absolutely. And we'll have to get you on to talk more about the RWAs, when there's more of them going around. But look, thanks so much for your time. We'll put links to all of that down below or up the side or somewhere in the sky. It'll be great. But go and check it out, and go and check out Nifty for some of the cool stuff they got going on, and Social Pass as well. So thanks again, Ty, and we'll talk again soon.
Thanks, George. Appreciate it.
Cheers.